I want to start with Apple. I know it's one of your longer-term holdings here. What do you make of the latest move? The stock has been on fire, poised to eclipse $500 a share. It's been a big couple months for the stock.
Yeah, Brian, thanks for having me. Listen, this feels a lot to me like 2012, 2013, when analysts were falling over themselves to upgrade the stock at historic highs back then. And then the company did a 7-for-1 stock split, and Carl Icahn and others entered the stock. That's when we were getting into it. And, at 10 times earnings, a yield of 2.7%, not very much good news was priced in. Here we are at 38 times earnings, 0.7% yield, although both of those yields were above the 10-year, it should be noted. But we think the company has a lot of fabulous things to be excited about. We just happen to think it's pretty fully priced in.
What is priced in, Nancy? There are so many analysts and folks on the street saying the 5G super cycle, it's going to be amazing. It's going to push up Apple's numbers. Do you think that super cycle is priced in, or do you even think there will be a super cycle?
Well, that's an excellent question. I do think there will be a super cycle. The company has about 1 billion, installed base, 1 billion users, and about 350 million of those are set for upgrade, 20% of which is in China. So we do think that there's good news on the horizon. But this rally feels very speculative to me. It feels kind of Robin Hood-y, people trying to get in before the 4-for-1 stock split. That's today. And then I think we'll see a pullback and investors will turn their attention somewhere else. But services is a great business. It continues to grow. iPhones grew last quarter. Nobody was expecting that. iPad has risen from the dead with at-home learning. So we do think that there's a lot going right for the company. But at 38 times earnings, we've been net sellers of the stock, still a major holding, but we'll begin even trimming that back in the coming months. And if I could just add one more thing, when the company warned on earnings at the beginning of 2019, nobody was in sight at $140 a share. And those are the times when you want to take advantage of a great company on sale, not necessarily at historic highs.
Now, Nancy, on a relative basis, Apple might look cheap compared to some tech stocks at 38 times earnings. If you think the move in Apple is in fact speculative, what do you make about the move in FANG more broadly?
Yeah, well, that is a problem, I think, although they're growing faster in terms of top and bottom line. So if you take a company like Facebook, the model that you might argue with the management, the model is hard to argue with. So that remains one of our largest holdings. We get a bunch of tech earnings this week with Palo Alto Networks, Salesforce. Those are things we're going to want to watch. And we own a number of those names, and they are trading at much higher multiples. They just happen to be in faster growing segments of the tech space. Netflix, Nvidia, those are a different subject. But we do like tech here, and we're overweight tech.
Yeah, we're getting some earnings this week from Salesforce, Autodesk, Intuit. Any of these names catching your attention here, or maybe in the semiconductor space as well?
Yes, so thank you for that question. Yep, we're overweight, as I mentioned, tech. We do own Salesforce. It's one of our larger holdings, not largest. We own Palo Alto Networks. I believe they report today. We own Lam and a number of the semis. So that's the portion of the space we really like. Autodesk, great company, a little expensive for us. Same with Intuit. But we continue to pick away at these stocks when they sell off. And that's exactly what we did during the bear market sell-off in March.
Nancy, when you hear a presidential hopeful in Joe Biden suggest that he would shut the economy down again if COVID-19 cases would spike, are you concerned about a potential double dip recession here in the country?
Absolutely. I actually felt like that was a pretty reckless statement. People's lives are certainly at stake, but we've seen improvement in that regard. We're seeing improvement in treatment, and more importantly, people's livelihoods are at stake. And so I do think, we had argued that this was going to be a stair-step recovery, and I kind of feel like that's what we're getting. We got the initial V bounce, and then we flatlined a little bit. But you look at the PMI numbers that came out last week, you look at consumer confidence, really rarely ever this high during a recession. I don't think that, I just think that was a gratuitous comment. I don't even think that's in the bag in the future for us to shut down again. I don't think people would tolerate it.
I want to get your take on the macro picture here. We've had the dollar selling off recently compared to the euro. It's at 2-year lows. Also, the yuan has been strengthening with respect to the dollar, perhaps a good sign. How does this fit into your macro view along with the interest rate picture?
Well, so we think a cheaper dollar, despite what the president says, is good for multinationals, and we own a number of those. But we also think that China is recovering, if you will, in a much more responsible way than they have in the past. So they're not employing crisis stimulus; they're employing targeted. Stimulus that we think will result in lower levels of inflation. We think that's great for the global recovery. Interest rates are problematic here. I mean, I just think, that's part of what's driving the stock market, low interest rates and super high liquidity. And if you look at the central banks around the world, they have grown their balance sheets by over 30%, M2's up 23%. Flows are still going into bonds. And we think that's what's going to drive the next leg of this rally is when some of that money starts coming out and moving into equities. And it's like a 4 or 5 to 1 ratio of asset dollars going into bonds versus stock ETFs.